Hi, welcome to the series on funding. And in this part 4, we are going to learn what are those 4 important things that you need to verify and be prepared before you meet your investors. As you know, that this is a 7-part series, and if in case you have missed the first 3 parts, the links are in the description. Do check them out now for an effective learning. Well, before you move forward, do not forget to subscribe this channel for more information like this. All the very best and happy learning. Now, you have decided. Let us all assume that while you are learning all of this, let us all assume that you are going for funding. The given thing is, yes, you are qualified for everything, your metrics and whatever things also I have told, it is done. Let us all assume you are going for funding. Now, how do you identify an investor? Very important thing, right? Yeah, funding. I've got a clarity here. I need to go for funding. How do I identify an investor? And before going to the investors, what are those minimum basic things? It is not sufficient that you are convinced that you need funding, right? It is also important that the investor is convinced that you need a funding. Do you agree with me? Do you agree that the investor also needs to be convinced that you will need a funding? So how will that investor be convinced? That investor will be convinced when you have some of these fundamentals very, very clearly done and worked out. And now we are going to ask these questions and ponder upon these fundamentals and work them out. What are those? Number 1, structurally assessing the need for funding, assessing the need or the readiness of the investor, pitch deck and business model preparations. And then once you finish all of those 3, the 4th thing that you do is you will target the relevant and the right investors. Now, how do you assess the need for funding? Again, while assessing the need for funding, this is very, very important. For this, if at all, you definitely need the help of a finance guy. Bring him on board as your co-founder, or pick up a nice, I would say, CA firm or a certified valuator, right? And then work along with them. They will help you build it. Don't if you are a tech or a business entrepreneur, don't try to attempt it just by yourself. It will take a lot of time. Take the help of experts, right? So what is it? The first one is financial forecasting. What is financial forecasting? Financial forecasting clearly says that based on the development of the companies at the given time period and then the sales that you wanted to project, it basically tells you how much money you need and what does this particular money do to your company and where will it take. Financial forecast. It basically depends upon the projection in the next 2 to 3 years. This is how I intend to grow, and for me to grow there, for me to achieve those sales, for me to be there in that particular market and in that particular thing, this is the money that I need, right? That's a financial forecast. And also it includes the fundamentals such as what is the cost of production, what is the cost for your product development, do you need a lot of money for research and manufacturing also. All these should be planned very, very clearly. And then you need to understand, if for you to extend to execute all of these things, how much money do you need? And if you really need money, see, somebody said, right, product side, it is just me and some of my friends. It's very clear, right? It doesn't need a funding in a product side because it is still evolving. So at this point of time, there is no plan that he would say that, okay, I need so many developers to build it, etc. Because he's still figuring it out, right? So assess the need based on your financial forecast and your product forecast. Now, how will the investor consider that you are serious, and then he will also resonate the same thought that you are ready for funding? Number 1, guys, gone are the days. Of course, there are still certain used cases, but I do not encourage such used cases where funding is raised just based on idea. Nobody at this point of time, especially the VCs, the funds have become with the economic recession that is already there in a couple of markets, and which is going to become very, very stiff. There is no free money available in the market. So then in such cases, how do you excite the investors? You cannot excite the investors with a wonderful idea. No, your ideas could be great, but that doesn't excite investors. Then what will excite your investors is you at any point of time, right? You are a pre-series or a pre-series funding or at a Series A funding, doesn't really matter. Show cash flows. Secure customer orders, onboard customers, collect money from the customer for your services. Show the cash is coming from the market, from the customer into your company, and from your company it is again going to different vendors, etc. Or if it is also getting into the profits, right? Ensure that you have at least a decent number of customers before you go to the investor. Now you will only get the customers when you have either a proto or a working model, right? So it is taken care. Cash flows and revenue model is very, very important. How is your revenue going to be? Where is your revenue going to come? How many number of customers you have? What is the average order value from each customer? And how many such customers you intend to develop? That becomes your revenue in the next 4 months, right? And are you making profits at a unit economics? What is unit economics? For every single unit that you sell, or for every single service that you give, or for every single product that you produce, were you able to recover the cost? Are you spending money to produce it, or are you making money in producing it? That is what is profitable business model means. And at the same time, now that you are, say, for example, your company's valuation is only 100 rupees, but you are 100 rupees, example, your total revenue is 100 rupees. You are only making a profit of, say, 5 rupees. It doesn't really matter. What investor looks at is 100 rupees, 5 rupees is making money. Can I fuel my money and make that revenue from 100 rupees to 100 crores so that 5 rupees of profit will become 5 crores? To make that 100 rupees to 100 crores, I will not invest 99. I mean, investor will not invest 99.95 crores. No. Investor probably will invest a crore, probably a 50 lakhs or a 60 lakhs kind of an amount to enable this 100 rupees to become 100 crores or a 1-2 CR. And in the process, that 500 rupees is becoming 5 crores. He will not only exit with his money, but he will also take a wonderful chunk as his bounty. Are you here with me, assessing the investors? So please, please, please do not go to any investors just with an idea. Doesn't really work out. Now, what are all the different ways? See, if you are well connected, see, right now the new trend is people who are already in the corporate world for many years, people who have made a name for themselves, people who have built a credibility for themselves in the ecosystem, etc. They do not have a problem because they are already connected with the investors. But looking at the program that you have joined in, I assume that though you made enough name and fame for yourself in this program, but I still assume that you are in the early stages, right? So please utilize every pitching opportunity, right? Pitching opportunities given by the incubators, by business competitions, models, etc. Go and start pitching to major networks and VCs, and then start approaching them on LinkedIn, etc. Investors targeting, right? And get incubated in a startup. And when you incubate in an incubator, ensure that you are getting incubated only for funding. Be very, very clear, especially when you come to the. Otherwise, incubators have a tendency of wasting time in giving you gyan, which probably will add value to you, but the value that you're looking at is not for the gyan, but you're looking at the money that the incubator will help you raise. This is not for you. Once you are selected for particular kind of a funding, you will play a supportive role. Why? Because the due diligence will be basically done by the interest of the investor. Investor will bring the right audit firm, investor will bring the right person. But again, as you go, I told you already, and I'm again repeating it, please onboard a CA who is a certified valuator, right? That is important, right? Now, the investor will put in the due diligence to say whether your numbers are right, whether your business model is right, whether your invoices, etc., are matching with what you have projected, etc. So this is all it is. Now, when the investor finally does it, I'm taking you to the flow of funding, right? When the investor finally is convinced that yes, yes, this guy seems good, then he will release, or he will ask you to sign a term sheet. Now, I will share a template of a term sheet which Y Combinator uses at their Series A product. Again, Y Combinator is a very, very interesting, right? They will enter at Series A, and how much percentage of equity they'll take? Anybody pick idea? Y Combinators. They enter at Series A, and then they take a particular number as a percentage of equity. Any guesses what that particular number is? Anybody has that idea? Or anybody knows what Y Combinator is? I assume you know what Y Combinator is. Their rule of thumb is they take 7% equity, and they have been successful, right? Now, how they achieved, etc., there is again a science and logic behind it. We'll not get into it, right? So this term sheet basically consists of 4 important elements. Number 1, what is the valuation of your company? Number 2, how is the investment that has come so far has been structured, and how is the structure going to change? Number 3, because of the infused money, how is the board of directors and then the management structure is changing? And number 4, again, because of the infused money, how is the share capital and then the shareholding patterns are changing. Now we are going to look not all of them in detail, but some of them in detail. Now let us first come to valuation. This is what I said, right? Valuation is basically, again, it is your perceived notion. It is an area where perception and reality kind of try to meet. Are you able to understand? There is no right and wrong method. There are around 4 or 5 methods. Again, this method is given either by your own valuator or the investor. Most of the times, it is the discounted cash flow that is running in the market right now. Otherwise, you have cost to duplicate method. You have market multiple method. Right? You have a valuation method by stage approach. But at this point of time, it's a DCF that is predominantly running. Again, nothing for you to worry. Don't get into this on understanding what it is. You may get into it, but then focus more on your business and let the investors and then the other guys and then the CA from your side take care of these things, right? They will choose it. You don't have a value, but then valuation is basically, it is where you bring a perception saying, hey, my company is so and so, I'm making a profit of so and so. Now my company, my product is used for every Indian, so 1.4 billion people will use my product, and accordingly my market is going to be so much so and so, and hence my valuation is going to be so and so. That could be your perception. Where this guy comes and says, hey, your market share is only so much, so it is not 1.4 crores, it is only probably 1.1, it is probably 0.5 billion only is your market example. And then that is where the perception and reality meet, and then you both agree upon certain particular valuation. Now, what is investment structure? Investment structure is, this investor might come either in one form, saying, okay, I'm only coming as an equity partner, or he can come as an equity plus debt. Right now, the combination has become a trend. He will, because this is the safe haven to the investor, right? Instead of giving, say for example, instead of giving his 100% into your company as an equity thing, now the investor also plays a more risk mitigated role. What he does, 50% he gives as an equity and says, okay, well, I will not expect a great returns on it. Make the capital grow. I'm here to make a wealth. Another 50% he brings it down a debt and says, by 50% may I need X% of returns. So that from the investor's perspective, his particular money, whatever he spent, is at least some of it is in shape and some of it is saved. Second thing, without necessarily giving you much money, he still got certain ownership on your decisions, ownership on your strategy, and control on you through the equity, right? So this is what these guys are doing. Now, management structure, the management structure will change based on these things. The board of directors, etc., will change. And now we are going to learn that particular thing very clearly. Similarly, the share capital that exists until this point of time also will change. These also will be clearly explained or mentioned in the term sheet. Now, again, okay, this is not about raising the fund or not. This is about how hard or how easy it is to raise funds. Again, I told you, right? Investors will only be interested, guys. Let me tell you, when you have this particular thing called revenue, agar ye nahi hai, then you need to be super duper company in terms of tech, right? If you do not have revenue, you cannot raise money. Simple. So this and this are no. This and this are certain things which are possible. But again, in either of these cases, if you are a non-tech company, then profitability is very, very important. Because tech companies in the initial days, they cannot define profitability for the kind of people and the resources that they put. But if you're a non-tech company, then you need to show a lot of profitability. If you're a tech company, you don't have to show profitability, but at least your unit economics before raising needs to be positive. Let us continue. And the same thing I'm going to build it with, right? This is what I said, right? So in this case, it is a complete no-no. Here, you're a tech company, but you don't have a revenue. It all depends on, it is definitely hard to raise. But again, if at all you're able to build an MVP and create some kind of an excitement among investors, you can go. But in this case, even if you go, you will not get. But these two cases have got high chances of investor excitement. So simple, guys, very, very simple. Investor always believes whether his money is growing or not. And that is defined by number 1, profitability, and number 2, by positive unit economics. So ensure that you are doing well in both these cases. Hi, hope you have enjoyed learning what are those 4 elements that you need to keep in mind before you meet the investors. See you tomorrow with a next series on funding.